Chevron finalizes Hess deal, expands oil portfolio. Chevron has officially completed its acquisition of Hess Corporation, adding premier upstream assets in Guyana and the U.S., Bakken shale to its global energy portfolio. The transaction, which follows a favorable arbitration ruling over rights in Guyana's offshore Stabroek block, positions Chevron for sustained oil production growth and increased free cash flow through the next decade. This merger of two great American companies brings together the best in the industry, said Mike Wirth, chairman and CEO of Chevron. The combination enhances and extends our growth profile, which we believe will drive greater long-term value to shareholders. Arbitration outcome unlocks strategic reserves. A key milestone enabling the deal's closure was the outcome of a high-stakes arbitration dispute with ExxonMobil. On July 17th, an international tribunal ruled in Chevron's favor, rejecting Exxon's claim that it held a right of first refusal on Hess's 30% interest in the Stabroek block. With more than 11 billion barrels of discovered recoverable resources, the block represents one of the world's most significant oil finds in decades. Currently producing approximately 650,000 barrels of oil per day, Stabroek is expected to reach 1.2 million barrels daily by 2027, according to project operator ExxonMobil. The ruling clears the way for Chevron to tap into one of the most prolific deepwater assets globally, providing a crucial reserve boost after Chevron's 2024 reserves dipped to 9.8 billion barrels of oil equivalent. Portfolio growth and synergy targets. The acquisition brings more than just Guyana. Chevron now adds 463,000 net acres in the Bakken, a key U.S. shale basin where Hess was a major producer. Gulf of Mexico assets contributing 31,000 barrels of oil equivalent per day, and natural gas operations in Southeast Asia producing 57,000 barrels per day. This accretive transaction is expected to drive significant free cash flow and production growth 2030s, said Eimear Bonner, Chevron's chief financial officer. We are quickly integrating our two companies and expect to achieve $1 billion in annual run rate cost synergies by the end of 2025. Chevron will issue approximately 301 million shares to Hess shareholders under the agreement, with a 1.050 CVX for HES share exchange ratio. Analyst perspective. A strategic win. Analysts view the acquisition as both strategic and financially sound. CFRA Research labeled the deal transformative, and Morningstar emphasized that Chevron secured high-quality assets with significant long-term upside. HSBC noted that the transaction may be earnings neutral in the near term due to high implied oil price assumptions, $80 per barrel, but that it is essential for Chevron's long-term strategy. RBC Capital Markets expects the company's share performance to strengthen, especially as Stabroek's production scales up in the latter half of the decade. Chevron's total production capacity now approaches 4.2 million barrels of oil equivalent per day, narrowing the gap with ExxonMobil's 4.5 million. Regulatory approval and governance update. The Federal Trade Commission, FTC, lifted its prior restriction on July 17th, clearing the path for former Hess CEO John Hess to join Chevron's board of directors, pending board approval. The FTC's decision removes the last regulatory hurdle after a nearly 9-month approval process. Chevron will provide updated long-term financial and operational guidance, including capital efficiency targets and production outlook, at its Investor Day on November 12, 2025, in New York City. You've been listening to Sustainability Soundbites from E+E Leader, where the business of sustainability meets real-world impact. Thanks for being a loyal listener. To inquire about brand partnership opportunities, reach out to a member of the E+E Leader team.